Chapter 10. Interest Rates and Monetary Policy. Monetary policy consists of a central bank's changing of the money supply to influence interest rates and assist the economy in achieving price-level stability, full employment, and economic growth. The Fed conducts monetary policy by changing money supply in order to influence interest rates. Even though there are many interest rates in the economy that vary by purpose, size, risk, maturity, and taxability, economists assume, for simplicity, a single interest rate. Interest rates are determined by the interaction of money demand and money supply. People demand money for two main reasons: to make purchases with it, medium of exchange, and to hold it as an asset, store of value. The demand for money as a medium of exchange is called the transactions demand for money. The amount of money people want to hold as a store of value is called the asset demand of money. The sum of the transactions demand and assets demand for money equals the total demand for money. The main determinant of the amount of money demanded for transactions is the level of nominal GDP. The transactions demand for money is vertical. Holding money incurs an opportunity cost. Therefore, the amount of money demanded as an asset varies inversely with the rate of interest, which is the opportunity cost of holding money. The asset demand for money is negatively sloped. The money supply is a vertical line because the monetary authorities and financial institutions have provided the economy with some particular stock of money. The intersection of demand and supply in the money market determines equilibrium price, or the real interest rate, the inflation-adjusted price that is paid for the use of money over some time period. The total demand for money, DM, is determined by horizontally adding the asset demand for money, DA, to the transactions demand, DT. The transactions demand is vertical because it is assumed to depend solely on nominal GDP rather than on the interest rate. The asset demand varies inversely with the interest rate because of the opportunity cost involved in holding currency and checkable deposits that pay no interest or very low interest. Combining the money supply SM with the total money demand DM portrays the money market and determines the equilibrium interest rate, IE. In this example, equilibrium interest rate is 5%. The goal of monetary policy is to achieve and maintain price-level stability, full employment, and economic growth. The three tools of monetary control are open market operations, buying and selling of U.S. government securities to change money supply, changing the reserve ratio to influence the ability of the commercial banks to lend. It is used very seldom. Discount rate, the interest rate the Federal Reserve banks charge on the loans they make to commercial banks and thrifts. Open market operations are the most important instrument for influencing the money supply. Buying securities increases the reserves of commercial banks. Excess reserves allow the banking system to expand the money supply through loans. Selling securities reduces the reserves of commercial banks. Lower reserves result in a multiple contraction of the money supply. Another tool is the reserve ratio. If the Fed raises the reserve ratio, the amount of required reserves that banks must keep increases. Banks will either lose excess reserves, diminishing their ability to create money by lending, or reduce their checkable deposits, and therefore the money supply, due to deficient reserves. If the Fed lowers the reserve ratio, the bank's required reserves will decrease. Banks with more excess reserves are able to create new money by lending. Federal Reserve banks make short-term loans to commercial banks in their district. In providing loans, the Federal Reserve Bank increases the reserves of the borrowing bank, enhancing its ability to extend credit. From the commercial bank's perspective, the discount rate is the cost of acquiring reserves. Increasing the discount rate discourages commercial banks from obtaining additional reserves through borrowing from the Federal Reserve banks. When the Fed raises the discount rate, it wants to restrict the money supply. How does expansionary monetary policy work? Suppose the economy falls into a recession and unemployment increases. The Fed buys bonds, lowers the reserve ratio, lowers the discount rate, or increases reserve auctions. As a result, excess reserves increase. The federal funds rate falls and money supply rises, which makes all interest rates fall. With lower interest rates, investment spending increases, and so does aggregate demand, leading to an increase in GDP. Here is how restrictive monetary policy works. Suppose the economy is overheated and inflation is a problem. The Fed sells bonds, increases the reserve ratio, increases the discount rate, or decreases reserve auctions. As a result, excess reserves decrease. The federal funds rate rises, and money supply falls, which makes all interest rates rise. With higher interest rates, investment spending decreases, and so does aggregate demand, leading to a decline in inflation. We can use the ADAS model to see this relationship between monetary policy and GDP. An easy money policy that shifts the money supply curve rightward from SM1 to SM2 lowers the interest rate from 10 to 8%. As a result, investment spending increases from $15 billion to $20 billion, shifting the aggregate demand curve rightward from 81 to 82, and real output rises from the recessionary level Q1 to the full employment level QF. A tight money policy that shifts the money supply curve leftward from SM3 to SM2 increases the interest rate from 6 to 8%. Investment spending thus falls from $25 billion to $20 billion, and the aggregate demand curve shifts leftward from 83 to 82, curtailing inflation. Monetary policy, a dominant component of U.S. national stabilization policy, has two key advantages over fiscal policy: speed and flexibility, and isolation from political pressure. Monetary policy can be quickly altered and is a subtler and more politically neutral measure. For the conduct of monetary policy, the Fed focuses on the federal funds rate. Interest rate banks and thrifts charge one another on overnight loans made out of their excess reserves. Other interest rates typically change in the same direction as the federal funds rate.